Okay, let's get started. All right, so this week I'm doing something kind of interesting. I'm going to be talking to you guys about three stock that I've purchased that went totally awry. Like these are scenarios that um, you know between psychological things and mistakes and all the other things, right? Like there's no way we can get every trade perfect. So these were trades that not only were they not perfect beforehand, but they weren't perfect afterwards. So they're super educational in that case. There's a lot of reasons, why a trade might go bad or not. But these are all things, and you'll see some patterns in here. But these are all things that can totally be dealt with just some risk management and some good psychological decision making and whatnot. So, okay, so the first one is TSSI. And as usual, I wrote a couple quick notes for you guys here. So, TSSI is a tech stock. They do information tech, IT services, or their hardware company. I wrote these puts back in November of last year, and I literally just got rid of them recently. So I've had them for quite a bit longer than a week. The original trade was just a set of puts, $16 strike price, and that premium on those came out to about $5,600. It's $1.25 a share. And look at the gain. I mean, this gain right here, I'm sure you guys see it on the screen, 7.81% gain on the premium. So this is the first kind of thing that you look at that's like, okay, well, that's insane, right? Like that's so much profit just on the premium. But the issue with with premium, like when you see premium that have that level of gain, uh, you ought to think twice about where you make that strike price. And so just to finish the writing in here, this cost basis, because of the $1.25 a share and the 16 strike, cost basis was $14.75 a share. So at the time, I'm thinking, well, that gives me a pretty good leeway. Like at $16, a 10% movement is $1.60. And at $1.60 down, that would put me at like 14.40. So I thought, okay, well that's pretty decent. But here's the other detail about this stock that you guys don't see at the moment. So this issue here, if you look at this November 10 to 17, right, that time frame, if we go back to November of 2025 right here, there's this earnings, right? There's this earnings sitting right here at November. And look at what happens. If I zoom in on this a little bit, look what happens at the earnings. We're up here and we end up dropping way down. Like we have this issue with these earnings. And so what ends up happening is that in this particular case, I think probably the issue is that there wasn't a whole lot of consideration around the earnings in general, right? So now when I do earnings and I put out the details about what to hit with earnings, it takes into account historical move. It takes into account implied move, and I always kind of create this risk reward blend, right? And TSSI is super volatile. I mean, if we go and look at it on a large time frame here, you can see at some point it was all the way up at 31 some dollars a share, and it's dropped way back down here to currently it's at 13.32 a share. So it's got this massive, you can see these massive swings. And in general, you look at this linear regression here, we look at it on like a daily basis, and it's, it has kind of an upward trend, at least at the moment, and you can see this earnings right here, right? So you look at how much that dropped down right there. Um, and here's the $16 strike, right? You can see this like right here, 1521. So when I wrote that $16 strike, it was just in the money. And that's why it fetched so much. And really, realistically, what I should have done is I should have went back and I should have said, okay, what's the historical move? What's the implied move? And I should have looked at those, and I should have I've built in a pretty good. I should have built in like a reasonable strike price, and I wouldn't have brought in 7.81% premium, but probably I wouldn't have gotten assigned at this really high value. And it was actually just very recently that, like I think I mentioned, that I got rid of these, that these shares actually got assigned away on calls. And at the end of the day, this 1475 cost basis, I've been writing calls on this stock for months and months, and I've brought in decent premium on the calls. So probably now I didn't sit down and crunch out every number and try to decide like, well, how did I break even on this? Did I make money? Did I actually lose money? All said and done, like there's too many calls, and I just was like, there's no way I'm gonna crunch all of those numbers right now. But the fact is that if I had written this strike for whatever the historical and implied move was, like closer to that, maybe like $13 a share, near earnings, instead of 7.81% gain, I could have seen maybe like 3% gain or 2% gain, which would have been plenty, and maybe I never even would have gotten assigned, or maybe I could have rolled it out had I looked at an assignment. So that's TSSI. They're, the other thing I'll mention about them before we move on is that they're not very liquid. There's not a lot of liquidity in this stock. So the buy and ask spreads on the options contracts are very large. So it's very difficult. Like I've had a very difficult time getting calls to go through at the price that I'd like, because the buy ask spreads are just humongous. And it's one reason why it's super important to just research a stock and understand the price movement and understand how easy it is to buy and sell. And I had been, when I executed this, I've executed a number of other TSSI trades before this. But dealing with the calls, and actually at one time TSSI didn't even have weekly calls. They were just monthly, or I'm sorry, weekly options. They were just monthly options. But that liquidity issue is probably why I won't trade TSSI anymore. Like now that it's gone, I probably will leave it be, because there's just not a lot of liquidity, and those spreads are just crazy. So, okay, so that's TSSI. Second one was Grid Dynamics. So let me go find Grid Dynamics here. So Grid Dynamics is it, of course, right? Of course, it's another hardware tech company. And I got into Grid Dynamics. I hadn't traded a lot with Grid Dynamics, and I decided that I wanted to play with them. And so I put in this strike. I put in here the trade details on this one. I sold puts on Grid Dynamics. Strike price was $22.50, and that was February 18 through 28. That's 2025, right? So that's not like 2 months ago. This is like I've like had this stock actually for like 14 months. And as you can see right now, it's at 548, right? So it's like literally dropped like 75% of the value that it used to be. Again, the same thing. You see this pattern here. Look, premium. I made on the premium for that weekly. It was like a week and a half out, days to expiration. $42.70 on the premium. It's $3.05 a share. It came out to be 6.77% weekly, right? So like that was like a week and a half. So it was actually higher than that. That's the weekly gain. And that put my cost basis at $19.45, which, of course, is better than the $22.50. But it's still, you look at this and you're like, right? It's this one's a little bit depressing. And so here's what happened with this. Again, if we go back February 18 to 28, let's see if I can get all the way back there here. So 25, February. Look at that. There's another earnings. Look at this earnings. It's right here. February 21. I think the earnings was actually February 18th. There we go. Okay, February 22nd was the earnings. And the problem here is that it's the same sort of thing. Oh, that's 24. Somebody's got to keep me on check here. I looked at the price. I was like, wait, did I do something terribly wrong? Okay, look at this. Here we go. February 21st. Let's see. Earnings is February 20th. Okay, so February 20th, 2 days before I wrote those puts. And look at the high. The high here, the day after earnings was 22.50. But the day here, this Thursday, right, it hit 22.50. So it's almost like it could have just expired worthless. But then it dropped. Look at this. If we look at the top of that candle, 20, oh, this is 25. Yeah. So the fact is that right after that, it spiked up. But I got assigned on there. I got assigned that. And ultimately what happened is that I should have came out and I should have gotten rid of this, right? Like I should have said, okay, it's dropping. Earnings report was bad. I guess, well, let's see if we can see it down here. Third quarter, October, July, May. Okay, it's not on the list, but it wasn't a great earnings. And we see this slope, this downward slope over time just continues down. And so this is a good example of where, I could have written a stop loss, but I said, in my head, okay, it's no big deal. I can just write calls on this and it's not going to fall out the bottom over time like this does. And this is kind of an interesting one in the sense that I still have this sitting in my account and I'm not, at this point, it's almost like this reminder, don't do, stupid things. Like you should have looked at the historical move. You should have looked at the implied move and you should have come up with a better strike price than just trying to milk it for premium right now. You got to keep in mind that there's a dozen trades going on a week and they almost all of them go well. Right. So it's not like this is a normal thing. Right. But sometimes you feel that emotion kick in. Right. And you feel this confidence and you feel like, oh, I know exactly what's going to happen. I can tell the future, blah, 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 blah. And then you learn that you can't. Right. And so you see this 6.77% gain here and you think, okay, well, that's, you see money in your eyes and it becomes emotional and you stop following your plan, right? And so these are those vulnerabilities. We looked at TSSI and we looked at this one. These are those vulnerabilities that kick in and cause these bad trades because you have FOMO or people talk about YOLOing it or whatever, right? And so that's what it boils down to is a really bad trader doesn't have any discipline, right? And a really good trader has nobody's got 100% discipline. Maybe a really, really good trader has 95% discipline or something like that in making sure that they follow their plan. But the goal is over time is that you temper that emotion and that psychology so that you push that percentage up towards 100, right? And so in some ways, this stock sits in the account, sits in my brokerage account, and it just kind of reminds me. And it's a small value, right? It's such a small, at least for what I'm usually trading, it's a small enough value that I'm not worried about it. Even if it goes under, it's a small loss. I've been continuing to write calls on it, and calls for this, it's monthly options, and calls for this stock I don't make a lot. I've probably made up this cost basis at this point up to 1945. But I'm not real worried about it. Like even if this stock goes up to, 20 or 25 or $30, I might not ever sell it. Like it might be the only stock that I just hold forever, because it's kind of this reminder of like, don't do stupid stuff. And so this is the perfect example of that. And probably everybody has one of these. This one's mine. This one certainly is worse than the TSSI one. And it will always be there. It'll always be there for me. So, okay, so that's grid dynamics. Again, based on the monthly options and based on low volume, I probably wouldn't ever come back to it. I don't think I'll ever trade on grid dynamics again unless they just become, huge and that whole picture changes. But so that's grid dynamics. The last one, which I put that little question mark there on, is Reddit. So Reddit has been a super interesting stock. And I'll come back to these trade details in a second here. I just want to show everybody here what Reddit kind of looks like over these long time frames. If we go back, let's see, 26, 25. So we can see here a little bit of a head and shoulders kind of thing going on with Reddit. We see it pops up to $229 a share back in February 25, right before Liberation Day, right? Then we hit earnings and it gets pummeled. And then, we come in and we hit April and it continues getting pummeled, right? And then it starts trekking back up here, starts trekking all the way up. In September of 25, it hits its 282 high, which is a 52-week high for Reddit. I don't know how far back we have to go to get higher than that. Maybe it's never even been higher. That might be an all-time high for Reddit. And then it comes back down, retraces down, comes back up, retraces down, down, down. And here we are now, back to $135 a share, which is the same price that we were at back in March of last year, right after Liberation Day, right? And then as it comes out later in the year in June. So Reddit is, has huge price swings. Like, if we look down at the bottom here, low, 73.64 in April, 7th of April, right after Liberation Day, 73.64, 282. Like I don't know if anybody's got a calculator sitting there, but like that's like a 3x, 4x, that's like almost exactly a 4x swing from the bottom up to the top. So like that's crazy. Like that's like grid dynamics levels, right? Can you imagine buying it down here and then selling it up there? I mean, that's just like not that would be a stupid thing to try to do, but it's it would be worth a lot of money. So okay, let's go back to the trade details. So again, I sold 4 Reddit puts. The strike was 212.50, and that was back February 11th of 2025. So if we go back to 2025, February 11th, and look at this. Talk about not actually buying the dip, right? It looks like a dip. It looks like a dip if you look at it right here. But then I sold those. Let's see, what did I say I sold them at? 212.50 on February 11th. So February 11th is right here. Oh, okay, so it's not even in the dip. It's kind of, there's a little dip in here. I get to claim a small dip. It's this little dip right in this little range right in there. Oh, no, actually, 11. Okay, here we go. February 11th. So there's a little dip right off the top right there. So 212, which coincidentally, if you look at this, at the time, the price was like 224. So it feels pretty reasonable, right? Like it feels like, okay, I'm down $10. Like I'm writing out of the money put for $10 strike below the current price. That feels kind of safe, right? Like that actually, like when you look at it, it seems kind of reasonable. But then you guys might not notice this little E down at the bottom of the screen, which stands for earnings. And earnings in this case was like February 12th. It was like the very next day. And so this strike was more reasonable than the other strikes. And I can't tell you what my exact mindset was the day that I sold those puts, but probably I didn't do enough looking at this. I probably did not do enough homework about that volatility swing. But that's why I said this one really caught me off guard, because like the strike, it wasn't like in the money. It's not like it was a stupid strike. It was just kind of a little bit higher than I should have been, or maybe I shouldn't have traded earnings, but it felt reasonable. And so that kind of caught me off guard in that sense. But then you can see earnings hits, and we see this big drop. We see the big drop, and it's not just earnings, right? Like it lost. We can say that at earnings we lost about 20%. So we dropped from 218 to 174. So the stock dropped 20% on earnings, which put my my puts well into assignment range. And I'm sure I tried to roll them to keep away from assignment, but 20% drop there. And then this factor, this extenuating circumstances, right, is there's this huge drop because all the tariff stuff came and hit, and everybody, was like crazy sell-offs, right? Well, so probably at this point, there's not a lot of good options, right? Like you get assigned right here, and in this case, it's already dropped so far below what you own it at that, it's difficult to know what to do, right? And so we'll come back to that in a second, because I haven't actually talked about all the details here, right? So the puts, 212.50 strike, February 11 to 18, they got assigned on February 18th. Premium came out to $5,100. That's $12.77 a share. And again, 6% premium gain on that for the week. So like huge premium number, but of course it's huge. Like it was right during earnings, and it was, the strike was reasonable, but it wasn't like probably where it should have been, right? So then my cost basis on this was not $199.73. And I think we decided that it dropped that 20%, put it into like 179, or I don't remember what number I said it was, but it was well below this, right? And so it turns out, there's kind of some interesting news here, is that it turns out that Reddit, I can't remember if I got an email or I saw something in TradingView. There was a piece of news that said that they were doing a class action lawsuit against Reddit. And so I emailed this lawyer and I asked about it, and they're like, yeah, well, if you've traded Reddit at any point, from this time period to this time period, then like you can get in our class action lawsuit. I was like, sweet, I traded Reddit during that time frame. I want to be part of the class action lawsuit. And I don't even know, like actually, it's been probably not 6 months or 9 months or something since I've heard from that attorney, and it's been just as long since I've owned the stock, that I don't know what all the details are, but they essentially were, this class action lawsuit was being put up because Reddit, there was some kind of price manipulation and whatever, and I don't know all the details, but like it's possible there's money coming back from Reddit for that. So okay, so that's the trade, 199 cost basis. If we go way back here, and I can't tell you, again, like I wrote all kinds of calls on this in the interim. I can't tell you what it was exactly that I sold it at or when, but it was way back here. It was like far enough back, like that I don't recall exactly when. It wasn't that far back. I'm not going that far back. Well, let's see. Let's go to the day view here, actually. So if we go on this, and we take a look, okay, so here we are, 4-hour view. So if we go back now, and what day did I say we did? It's February 11th, 2025. So we're at the beginning here. I bought this. It dropped all the way down here to 75. And I've still, mind you, like when it hit 75, like I still owned this stock. I didn't get out of it because, like I said, by the time you see this thing drop off down here, you give it a couple of days, sure, it came back up. And I probably, if I had to redo this again, and this kind of informed some of the trading plan stuff, is that I probably would have just sold it right here. Like at this 205.03, I could have sold it and, really not lost that much money. Like it was only 4 puts or 5 puts, whatever it was, like It's not that many shares. Like I would have lost a couple few $1,000s. It wouldn't have been that big a deal. Losses are just part of the game. And so, in this particular case, I probably should have just sold it off that was still within, I'm sorry, this is February 18th, is still within it. So it drops down, let's see, February 18th, Tuesday, that must have been a holiday or something, the 17th. So I got it here, and then it drops. It drops all the way down here. And then it comes back up here at 173. And at that point, it's low enough that it's like, yeah, okay, I'm not sure I want to sell it there because that's a big loss, right? And then it just plummets, right? It just tanks all the way down. And so this whole time I'm writing calls on this. It starts coming back up. And I think it was probably around this time, this next earnings right here in August, that I probably ended up getting rid of it because I had written a call and the call had kind of gone underwater because you can see at this earnings, it just explodes. It explodes right around this range here in this June timeframe, and then it explodes again right here. And so there was some point during all of this that I had written a call and that call just went way underwater, and I rolled that call and I got it as high as I could. It was probably in like the mid 150s or something like in that range here where it got underwater, and it just kept going and going and going. And so that call was underwater and I had to just let it go. And again, by that time, like months had passed, I'd recuperated probably most of that loss in the form of calls on premium calls, calls on premium, or I'm sorry, premiums on calls. But there's still some loss there, and again, like it dropped off so rapidly here, and then it gained so rapidly here that that's the place with options where you just got to be really diligent, and you've got to be safe, and you've got to be patient, and especially when you own a stock that is way under what you own it for, you've got to really make sure that what you write, like that you're okay with the consequences. And in the case of Reddit, when we have these major swings, you've got to be ready for that. And if you're not ready for that, then you just don't write the option. And in some cases, not writing the option is a good call, even if you hold it for a few months. This came all the way back up here to 250, right? And so if I had held it, even if I'd held it just for this and sold it just at the top of this green thing in August, and I'd gotten up to 194, set a limit, just a limit order for $195 and just let it be, then probably that trade would have been a whole lot less stressful. And so when we look at these guys where you were talking like 6-7% premium gain, there's some extra risk there and there's some extra reward there. And I think last year on premium gain, I hit a total of 1.2% for the year. And the losses that came from trades like Reddit and TSSI and Grid Dynamics are the thing that push that down, right? And so the goal is really that you just work on those percentages, right? Like that it's okay, right? Like losses are no big deal. You just have to trump them with a bunch of really nice gains. And so in this case, there's these are the three thorns in my side from the last year, which ultimately three bad trades in a year is not too bad, especially when you're probably above average risk level. So anyway, those are the three stocks the three worst trades I made in the last 12, in fact, probably the last 14 months, if you consider TSSI, Grid Dynamics, I think was February. So the last 14 months, these are my worst trades. So anyway, hopefully that's helpful. I think the big takeaways there are that you've got to be super careful when you see a premium that's so high, this 6% premium. When you see that, you got to really temper the emotion there. Don't worry about the FOMO. Don't worry about, how much money you're going to make off of it. Just do some risk management and make sure that you're looking at that nicely. Like 6% premium is probably too risky. Like 3% premium is reasonable. 6% is that should probably raise a red flag. And then the second thing, which you noticed, which I think I illustrated on all three of these stocks, are the earnings. If you're going to approach earnings, and I work with people on earnings, and I play earnings, but generally I do them in a far safer way than these three stocks. So if you're going to play earnings, then like you got to make sure that you're ready for the swing in case the earnings goes south, because with some earnings, especially in tech, bad earnings can drop a stock super fast. So those are good takeaways. If anybody has any questions, feel free to reach out. And also keep in mind the market is officially closed for the week. Tomorrow the market's closed. So we'll get the weekly blueprint out a little bit early, I suppose. Anyway, hope you guys enjoyed. We'll see you next week for a new topic, and have a good weekend. Take care.